The first tremors of the earthquake are already shaking things up, and you can feel it in the air. Corporate defaults are creeping up, bit by bit, as more companies struggle to refinance under the heavy burden of those skyrocketing interest rates. Remember when cheap debt was their lifeline? Well, that safety net is gone, and now we're seeing the day of reckoning unfold, one bankruptcy at a time. It's like watching a slow-motion train wreck, right? Just think about it. Small businesses that thrived on easy loans are now facing tough choices, and larger firms aren't far behind. The financial landscape is shifting, and it's a wild ride for everyone involved. Just look at the tech sector. Companies that were once thriving are now struggling to keep their heads above water. It's a wild ride, and it feels like we're all holding our breath, waiting to see what happens next. The ripple effects are real, impacting jobs, investments, and even our everyday lives. It's a tough pill to swallow, but we need to wake up and pay attention before it's too late. These aren't just struggling businesses, they're what you'd call corporate zombies. Seriously, these firms are in such bad shape that they can't even rake in enough profit to cover the interest on their own debt. Picture this. Imagine running a household where your income is so tight that you can barely pay the interest on your credit cards and mortgage, let alone cover the basics like food or electricity. It's a scary thought, right? Well, that is the harsh reality for about 2 out of every 5 companies on the stock market today. It's like watching a slow-motion train wreck. Companies that should be thriving are barely hanging on, and it raises some serious questions about the health of our economy. How did we get here? What does it mean for all of us? So how do they survive? They exist on a form of financial life support. These zombie firms stay afloat by constantly rolling over their debt, a desperate game of borrowing new money simply to pay the interest on their old loans. It's not a strategy for growth or innovation. It's a permanent state of survival, a house of cards built on an ever-growing mountain of borrowed cash. This isn't a temporary problem for a few niche industries. It's a systemic feature of our modern economy. This plague didn't appear overnight. It exploded after more than a decade of near-zero interest rates. Central banks, in an effort to stimulate growth after the 2008 financial crisis, made money artificially cheap. This policy acted like a morphine drip for the economy, allowing fundamentally weak and unprofitable businesses to survive when market forces should have let them fail. They became addicted to cheap debt, and the financial system was happy to supply it. But now, that era is over. Interest rates have surged at a pace not seen in decades, and the cost of that debt is now crushing these companies' already paper-thin margins. The financial life support system is being unplugged. The easy money is gone, and these zombies are now staring down the barrel of a mathematical certainty. Their debts are becoming too expensive to sustain. They are trapped, and the walls are closing in. You can see the casualties piling up in the sectors hit hardest by post-pandemic shifts. Brick-and-mortar retail chains, commercial real estate ventures with empty office towers, hospitality businesses still reeling from lockdowns, and countless tech startups that were burning through cash with no path to profitability. These were the businesses that feasted most voraciously on cheap loans, and now they are the first to starve. Fueling this crisis was the meteoric rise of private credit and a lax corporate lending environment. A shadowy world of non-bank lenders, hungry for yield in a low-rate world, funneled trillions of dollars into these weak companies with few questions asked. This kept firms alive far longer than a healthy market would have ever allowed. Lenders built entire portfolios on the fiction that these zombie companies were viable investments. Banks and other traditional investors are really trying to dodge the inevitable, right? It's wild how they often refuse to push for defaults or bankruptcy. Why? Because facing those losses on their books feels like a punch in the gut. It's way easier to pretend that a bad loan is still golden, kicking the can down the road and just hoping for a miracle to save the day. This creates this dangerous illusion of stability, hiding a massive black hole of bad debt lurking just beneath the surface. Imagine a ticking time bomb. Eventually, it's going to blow, and when it does, it's going to be a real mess for everyone involved. So, what's the endgame here? The consequences of this charade are pretty devastating. You know, it creates this hidden, massive drag on economic growth that we can't ignore. Capital and labor, which are the lifeblood of a thriving economy, end up trapped in these unproductive, failing companies. Instead of flowing into innovative new ventures or businesses that actually get things done, They're held hostage by these zombie companies. It's like having sludge in an engine, slowing everything down and making it hard for the whole system to run smoothly. Imagine if that cash was freed up and invested in startups or tech firms that could really change the game. It's frustrating to think about how much potential is just sitting there, wasted. The damage doesn't stop there. These zombie firms distort the very nature of competition. Because they are subsidized by endless debt, they can afford to operate on razor-thin or even negative margins. They keep prices artificially low, making it impossible for healthy, well-run businesses to compete. The zombies are not only failing to create value, they are actively preventing healthy companies from succeeding, crowding them out of the market. This is honestly something that should send chills down your spine. Analysts are ringing alarm bells, saying the number of so-called zombie companies in our economy is creeping up to levels we saw in Japan during its notorious lost decades. Can you believe that? Japan kept these struggling companies alive for years. And guess what? It led to 2 decades of economic stagnation that they're still trying to shake off. We're not just flirting with that pattern. We're already knee-deep in it, and it's super concerning. If we don't act soon, we could be facing a similar fate, and that's a reality check we all need to take seriously. The first tremors of the earthquake are already shaking things up, and you can feel it in the air. Corporate defaults are creeping up bit by bit as more companies struggle to refinance under the heavy burden of those skyrocketing interest rates. Remember when cheap debt was their lifeline? Well, that safety net is gone, and now we're seeing the day of reckoning unfold, one bankruptcy at a time. It's like watching a slow-motion train wreck, right? Just think about it. Small businesses that thrived on easy loans are now facing tough choices, and larger firms aren't far behind. The financial landscape is shifting, and it's a wild ride for everyone involved. To the outside world, many of these companies look fine, but internally, they are bleeding out. They are quietly cutting staff, delaying payments to their suppliers, and selling off valuable assets, not to invest in the future, but just to make payroll and keep the lights on for another quarter. It is a slow, agonizing death, hidden behind optimistic press releases and accounting tricks. The stock market, for its part, has largely failed to price in this enormous risk. Why? Because the accounting practices of these companies are designed to mask the true weakness. On paper, revenues might look stable and assets might appear valuable. But the cash flow, the actual lifeblood of a business, tells a story of terminal decline. The market is trading on a fantasy. Private equity-owned zombies are a particularly fragile and dangerous part of this ecosystem. These are companies that were bought using immense amounts of borrowed money, a strategy known as a leveraged buyout. Burdened with this extreme leverage from day one and possessing very little cash flow, they are the most vulnerable of all to rising interest rates. They have no safety net. The danger isn't just a wave of individual bankruptcies, as painful as those will be. The real threat is systemic contagion. When these companies fail, they don't fail in a vacuum. They default on loans to banks. They stop paying their suppliers, who then face their own financial crises. They lay off thousands of employees, devastating regional economies. A single zombie collapse could set off a chain reaction, causing panic and chaos in the whole financial system. If too many of these firms collapse at once, credit markets could seize up entirely. The flow of lending that our economy depends on could freeze, hitting the banks and pension funds that hold trillions of dollars of this now toxic corporate debt. Your retirement savings, your bank's stability, it's all exposed to this rotting foundation. This puts governments in an impossible position. They will face immense pressure to intervene, to bail out the zombies and prevent a wider collapse. But any bailout would only reinforce the moral hazard, teaching a generation of executives and investors that reckless borrowing has no consequences. It would be a temporary fix that guarantees an even bigger crisis in the future. Here's the raw truth, folks. The longer we let these economic zombies hang around, the more dead weight piles up beneath the surface. It's like a ticking time bomb, right? Every day we put off facing the music, that sickness spreads. And trust me, the price we'll pay later just keeps climbing. Think about it. Businesses that should have closed ages ago are still limping along, dragging down the economy. It's a mess waiting to explode. Investors and policymakers are finally asking the big question they should have years ago. What's next? Are these higher interest rates finally going to push us into a cleansing recession? You know, that tough but needed shakeup to get rid of the dead weight in our economy? Or will we find a new way to keep the zombie economy stumbling forward, delaying the inevitable and making the ultimate crash even worse? But here's the real kicker, the question that might keep you tossing and turning at night. And turning at night? If 40% of our companies are basically zombies, how much of our economy is really alive and kicking? Think about it.